The broadcast is now starting. All attendees are in listen-only mode.
Hello, this is Sam Stovall, Chief Investment Strategist at CFRA, and I welcome you all to our first quarter 2020 webinar, talking about independent research, independent results, our 2020 predictions, CFRA's best ideas for the new year. Joining me today on our webinar is Ken Leon, who is our Director of Equity Research here at CFRA, Kathy Seifert, an industry analyst covering insurance at CFRA, and Angelo Zeno, an industry analyst who covers our tech and communication services categories. Before we get started into this presentation, I wanted to remind you that today's session is being recorded and a link to the recording will be made available within the next few business days. The slides for today's presentation can be accessed using the GoToWebinar panel under Handouts, and they're available right now. You may also submit questions using the GoToWebinar panel, and we will do our very best to answer as many of these questions as we can. So let's get started. Topics of discussion: 2020 predictions and outlook. We'll do a very brief 2020 market forecast. Then we will hear from Ken talking about diversified banks, from Kathy talking about the insurance industry, and then from Angelo on the technology hardware space. Why specifically finance and technology? Well, these two sectors happen to be the ones that we are currently recommending as overweights, as found on our Market Scope Advisor Sectors tab. We will then follow up the presentations with a question and answer session. So getting started, we have a year-end 2020 target of 3435 for the S&P 500. Performance clues are, well, typically good years follow great years. Since World War II, whenever the market was up by 20% one year, it was higher by an average of 10% the following year, rising more than 80% of the time. We also had a below average differential between the best and the worst performing sectors. Like a compressed spring, they tend to jump and show an above average price appreciation in the subsequent year. We think that the Fed will maintain its rate reduction policy for 2020, and it's a reminder that a fourth year of the presidential cycle tends to be good. Not as good as the third year, but good nonetheless. We would be remiss if we didn't mention that there are still headwinds out there, high valuations causing concerns about the market possibly overheating. We do believe that with valuations around 19.5 times 2020 estimates, that maybe we could be vulnerable to a digestion of recent gains, but that does not deter us from our bullish outlook for the full year. Another concern could be that as the economy continues to strengthen, investors might be voicing the worry that maybe inflation will be picking up as well. We do not see this. Lastly, potential escalation of the Iranian military tension, which seem to simmer down very, very quickly. Tailwinds, however, we are getting it right now. We recently signed the USMCA as well as phase 1 with China. Expectations are that that could benefit GDP and earnings growth for the coming year. And I remind investors that the dividend yield on the S&P 500 exceeds the yield on the 10-year note. Since 1953, whenever that has happened, the market has been higher by 18% on average, rising about 85% of the time. In terms of looking at the Iran military situation recently, I looked at 20 such situations where we had military and terrorist market shocks since World War II. Surprisingly, we end up getting back to break even very, very quickly. On average, as we see from the summary on the bottom, the market falls about 1.2% on the day of that shock. We are down an average of about 5% from peak to trough. The bottom typically took place over 22 calendar days, and we got back to break even in 47 calendar days. Following the most recent killing of the general in the Iranian general in Iraq, you can move a decimal point. The bottom took place only a couple of days after the event, and we got back to break even and have been setting new all-time highs less than a week after the fact. Things that you can look at from the end of January, end of February, end of March that could indicate whether this market will continue to work its way higher throughout the calendar year. We all know about the January barometer. As goes January, so goes the year. Since World War II, whenever the market was up in January, it was up for the full year 91% of the time and posted an average 20% total return. At the end of February, take a look. If the market is up in both January and February, which has happened 29 times since World War II, the market was higher in the full calendar year, 29 of 29 times, averaging a total return in excess of 24%. Lastly, if the first quarter low is above the low posted in December of the prior calendar year, the market was higher 100% of the time, and the average total return was 22%. We're going to be talking a bit about earnings, and as we can see in the slide number 7, basking in easier EPS growth comps. If you look at the two right-hand columns, you'll see that in 2019, we have a multitude of sectors that are expected to post year-on-year declines, double digits, especially in energy and materials. But looking to 2020, we see that 10 of 11 sectors are expected to be higher, with the S&P itself up nearly 8%. One of the reasons we'll be talking about financials is because from a technical perspective, things are improving. This is a chart. The blue line is a rolling 52-week relative strength between the financial sector and the S&P 500. We essentially bounced off of one standard deviation below the mean, moved above the 39-week moving average, and remain above that moving average. Slide 9 shows the fourth quarter 2019 earnings growth expectations for the sub-industries in the S&P 500 financial sector. And you can see a majority of them are expected to post positive results. And what we're looking for in the fourth quarter is that now all are expected to be positive based on the most recent revisions, and the multi-line and reinsurance, which originally had been seen at minus figures back on the fourth quarter of 2018, are now expected to post positive results. So look for good financial growth in this sector. In the next slide, again, looking at the technical picture for information technology, we also see that this sector is outperforming the S&P 500 and is above its moving average. So from a technical perspective, the trend remains our friend. And then lastly, looking at the fundamentals for the technology, we see that all are expected to post positive returns. Year-on-year percent changes, however, range from growth of 24% down to a decline of nearly 21%. So with that, as a quick lead-in for the analysts to discuss the different areas, I will pass it over to Ken Leon, who will discuss the diversified banks.
Thanks, Sam, and really excited to talk about the banks today. The timing is perfect. We've actually completed 6 of the largest banks in terms of their results for the fourth quarter. The diversified banks, they actually capture about 70% of U.S. bank assets. Our conversation today will speak about their predictions, outlook, and then as we go through each of the slides, you'll see some other predictions related to business drivers. But these are the biggest ones. The first is America First. It's part of our view about the U.S. banks and recommendations that the U.S. economy drives bank growth. Most of the large banks have most of their percentage of revenues coming from the U.S. They are global, but generally they have low risk in parts of the world where we see risk exposure, China being one of them. Another element of the prediction is really an interest rate rise. consensus is mostly looking for rates to be flat to down. We possibly see through 2020, perhaps right after the election, the Fed possibly going back to a rate rise regime. Right now, they're on the sidelines. So we're bank analysts, and one of the concerns always is systemic risk to watch on credit quality. We'll get to that as it relates to potentially in the energy, oil, shale producers, talk a bit about shadow bank loans. And finally, one big prediction, unlike the Obama elections, we don't expect banks to be in the spotlight as it relates to a punching bag. Perhaps that's pharmaceuticals with prescription drug pricing. Moving to slide 14, these are the key drivers for the diversified banks. It's economics. The consumer demand is incredibly important. It's an engine for growth. Business loan growth is still stable. We also see this driven by job growth, increase in household income, and households are still not over leveraged. Other factors, of course, relate to outside the U.S., geopolitical risk that can also affect the capital markets. And then policy and regulation. I mentioned the Federal Reserve is on the sidelines, and we'll talk a bit later about how under the Trump administration, federal agencies are really doing a great job with coordination. Slide 15, another way to look about outlook is the bull versus the bear case. We're in the camp of the bull case. We're optimistic as it relates to especially even in the first half of this year when you have a kind of a flat rate environment, we're seeing that drive loan growth. So the offset to perhaps flat net interest income is the businesses are doing really well, particularly the consumer. As we go through 2020, the cynics will say that the comps get more challenging, and then certainly we'll get to the aspect of return of capital. We are over a decade since the financial crisis, but there's an annual cycle in terms of submitting your capital plans to the Fed. That happens in the first quarter, and at the end of June, we get to see what they're allowed to do in terms of dividend rise and buyback. Slide 16, performance. Slide 17, you can see here, essentially, if you were not invested in the diversified banks for most of 2019, that was okay. But in the fourth quarter, we did see strong performance. The diversified banks, which is the orange line on the top, outperformed the S&P 500 and the regional banks. Unlike regional banks, the diversified have capital markets, and they have in the consumer area the card business, which is an enormous driver for growth. And of course, the Federal Reserve became more accommodating in the fourth quarter. So now looking at bank fundamentals, every bank management really earns their keep on really this slide, which is managing bank assets and liabilities, the matching, the funding of costs, what will the spreads be? We'll highlight a few of these on the left. We'll also talk about real estate loans, commercial and consumer, and then a little bit in terms of the cost of deposits, which are important as well. On slide 20, you can see the first example. Our prediction is that consumer loans will continue to lead in 2020. That clearly is being driven by the economy. When we look at the different components of consumer loans, the ones that are the largest is loans to individuals, but it also includes small business. Banking at these levels is generally done person to person at the branch or online. Credit cards also are a big engine for growth. Areas of concern a little bit is auto loans, credit quality. We're seeing anecdotally where some of the shadow banks, not the large diversified banks, are really more aggressive, and perhaps borrowers not fully aware of borrowing to get a Ford 150 truck. And then 3 years later, your loan is bigger than the next one that you need. Next prediction is commercial real estate loans will tighten in 2020 on slide 21. So first of all, looking at the chart itself, the very bottom line is the important one, and that's a diversified bank. So the magnitude of commercial real estate to total assets of these banks, the largest banks, is very small, and they have become more conservative. It's kind of like the canary in the coal mine as it relates to recession or to credit loan risk. And generally, when you get in a real estate market, you have the risk of oversupply. The regional banks, which is a line much further higher, they have a higher percentage of their loans coming from commercial real estate. So I cover the real estate market. So far, vacancy absorption rates are good, but this is an area that the largest banks are being more conservative. Next is the shadow banks, and this is really about residential mortgages. It's interesting that while there's a few of the top 6 banks that are in the top 10, there's a number of banks that we call shadow banks. And they really are part of lending for family residential mortgages. So far, we haven't seen any situation where there's risk in terms of not being able to pay your mortgage. The low mortgage rate environment has been really an engine for mortgage originations. We did see it in the fourth quarter, just reported this week. But some of the shadow banks might be more aggressive than the Wells Fargo, JP Morgan, or Bank of America. Top 10 names are Quicken's Loans, Lending Tree, and there are others. So that's another area that I'm watching as it relates to risk. The other part of the equation is really looking at net interest income and credit quality. So we'll go into the rhythm talking about rates and some of our predictions. The first one is that rates could move higher in late 2020. We think that might be because of mostly a stronger economy, not necessarily because of inflation running away from us. I would put a stake in the ground that we're going to see 2% or higher GDP growth. And that, of course, would lead to a better scenario for large banks. Right now, the large banks have to manage in a flat rate environment. That means that in terms of looking at the returns that they're getting, it's going to be a little bit more challenging. Most of 2019 was this scenario of margin compression. Deposit rates, less of a factor. And if you're a bank analyst or you're in the industry, you talk about bank betas, which essentially is trying to look at your cost of funds and what kind of rates you're going to be offering. But we're seeing that for the large banks, relationships are greater than just the CD at the bank. So we'll be watching margins. Slide 25, and this is really what drives the whole picture for rates, is the U.S. Fed funds, which impacts LIBOR, key for borrowing, and CD rates. It's generally still fairly benign. Lower rates, potentially, we are seeing beginning of better spreads late in the fourth quarter, and that's going to help the banks in 2020. Slide 26 is another one on the interest-bearing deposits. You know, for several years, and especially for those who are retired, it was always frustrating because CD rates were below 1%, and rates have risen. And we're seeing an increase, which is the orange line here, of interest-bearing deposits. This is the largest, and it is growing. Then it leads to slide 27, which is our next prediction, which is net interest margins will widen the second half of 2020. We think rates, which are right now flat and also difficult on spreads, will begin to widen. Net interest margin is a key metric in the industry. And again, it's not just the changes of rates for banks, but it's really the matching of maturities of assets and liabilities, the loans and investments versus deposits and borrowing. Slide 28 is a graphic of this. It's really a good future reference for you, but it shows on the left all of the factors that impact rates, whether it be from deposits to assets, ultimately that leads to yields and net interest spread. And on the right side is the volume. Where the banks are doing great across their businesses, whether it's traditional banking or from the capital markets is the volumes. The volumes are increasing net interest income more than the spreads. But we see, I think, a better picture towards the second half of this year. Quick comment on credit quality. And here you can see that we don't have any industries or an episodic event that's going to trip up banks in 2020. Our prediction is that it's going to be generally calm, it'll be manageable, and we think for the largest banks, while we look at their provisions for loan loss, non-performing loans, the allowance and reserves, there's not going to be much really to talk about there. So let's go to the more exciting area, which is the capital markets. And the capital markets, we see in 2020 more of a risk-off environment. Part of this is really related to the political uncertainties and also CEO confidence, which is still negative. The U.S. economy itself is strong. We did see in the fourth quarter generally strong results in the capital markets, but in some cases that was off of weak fourth quarter 2018, easy comps. The comps in the capital markets will be more challenging in 2020, but there's going to be some areas that will do better than others. Equity underwriting, it's interesting. On the conference calls we've had this week, none of the major banks really talked about a lot the IPO market or the pipeline for 2020. Some of the headwinds here is just equities are expensive. That's good for us, not necessarily if you're out there wanting to do deals. Also, we did have some disruption in the IPO market this year. Many of us tracked closely the WeWork situation, and also Uber and Lyft were really not good in the aftermarket. So IPOs, which is a high fee part of equity underwriting, probably is going to be more moderate in 2020. Next is M&A, and across the 6 largest banks, we did see year over year and sequential decline in M&A. The transaction sizes, though, are getting larger. I think part of the pullback, it was geopolitical, mostly U.S. and Europe on trade. Cross-border deals was down significantly. Transactions in Europe for M&A were down. And then on the far right, you can see that CEO confidence, it ticked up. January 7th reported an indicator of 43. It was 34 in Q3. You really need to be well above 50 to get the animal spirits of CEOs to get involved in M&A. From the regulatory side, and we'll get to that later, there's no impediment as it relates to antitrust. Generally, if the deals make sense, they're going to get done. Talk about liquidity, and there's several areas. The one I'm going to focus here on slide 34 is leverage loans, but then other areas is the repo market. And leverage loans are important. It's a market that's over $1 trillion, but the credit terms are beginning to tighten again. They were as aggressive in 2019 of covenant-like terms, and it really feeds into private equity deals in terms of how much they want to leverage versus put their own capital in. So it's an interesting area, but one that also impacts capital markets. Next, we're going to go to regulation. So looking at regulation, first want to say that both the Federal Reserve and the Trump administration have done a great job. We've seen headwinds move to tailwinds as it relates to pragmatic regulation. There's been terrific coordination between the Fed, led by Vice Chair Randy Quarles, the Treasury Department, as well as the FDIC and the Office of Control Currency. All this means is that there's more transparent, pragmatic regulation that leads to a better environment. On the far right, under C, is the bank stress tests and capital plans. This is the annual cycle, again, which really drives for us as investors total return. We expect it to be another great year. The 6 largest banks have generally been a green light. Sometimes there's conditional approvals, but this sets you up well for total return and higher yields on bank stocks. Moving next to slide 37 is the LIBOR replacement. LIBOR, and this goes back to the scandal several years ago, it was actually 2012, there's been interest to have new parties set up what is called the secured overnight financing rate. In many cases where adjusted rates are involved, LIBOR is important. So we're going to have this transition that does go into effect by 2021. The U.S. has a slight different view of the definition and how they're using it, and it applies to mortgage rates for Fannie Mae, Freddie. So it is important. It will sunset. The next regulation, so CFRA is by far the leader in forensic accounting. We have done a report on banks as relates to CECL. CECL is the accounting increasing the allowances. It's called the current expected credit loss. This will impact earnings, at least the reported earnings, in 2020 by $1.5 to $2 billion for each of the large banks. It's something we are watching, you know, as we all know that when you see, well, what are the real earnings or the adjusted earnings? And CFRA is great at looking at those adjustments, but this is one on the table for 2020. Finally, let me move to recommendations. And I guess my key message is, if you just bought the group, all boats rose in 2019. We had great performance. I think in 2020, we're going with the America First. I have a more conservative approach in my recommendations, mostly going with the largest, more mainstream banks of Bank of America and JP Morgan. Each of these have 80 to 90% of their assets in the U.S. and also they are leading in terms of gaining market share in terms of the consumer and small business market. They're also top 3 players in the capital markets. Wells Fargo, you would say, should be America First, 100% in the U.S. They have a new CEO, Charlie Scharf, and he's going to take most of this year to figure out his transformation. We had to sell. We went to that in December. I think the call this week was somewhat disappointing. It's not only the Federal Reserve consent decree and asset freeze, there's 11 other regulatory investigations. It's going to take time. Wells Fargo used to sell at a premium for decades. It doesn't anymore. We're going to be on the sidelines at least the first half of the year on this one, but it's sell. Citigroup, you would say, only 46% of the revenues, but kudos to Citi, even with the fourth quarter results, they're able to manage their global network well, essentially for their institutional business. Mexico, Southeast Asia are areas where they have exposure. I would say there's a risk here, which is why it is a hold. And finally, Goldman Sachs. They reported yesterday, unlike, I don't have Morgan Stanley today, it's up 7%. They had great capital markets performance. Goldman has their first ever investor day, January 29th, talking about their pivot to the broader mass market and also trying to appeal to the millennials as they begin to fill in the different levels of wealth management. I would argue Goldman Sachs doesn't have 16,000 advisors like Bank of America, Merrill Lynch, or Morgan Stanley. It takes time. They already indicated that they will give some idea financially about the longer-term return on investment, but it's not going to help profitability in 2020. And the last point I'd like to make just about the diversified banks and capital markets, things can change, which is why we have the America First recommendations, because I want that stable, large, traditional banking, because it's very hard to get consistent, strong performance in the capital markets, and the public equity market does not give you a big premium for doing great in trading. And most of these banks with regulated capital want to downsize trading, and they want to move into more predictable business. So with that, let's go to our next area, which is insurance with Kathy Seifert.
Good morning, everyone. It's good to be with you today. And I'll start with the property-casualty industry, where we have a positive fundamental outlook, largely driven by our view that pricing for most lines of coverage is likely to remain firm after several years of record catastrophe claims. As a result, we're looking for written premium growth of about 5 to 7% in 2020, which is above the industry's long-term compound annual growth rate of about 4.2%. Insurance reporting season hasn't started yet. We expect that'll happen later in the month, but when it does, we think year-to-year results are going to be helped by an expected decline, or what we see as a decline in worldwide catastrophe losses. Late 2018, particularly in the U.S., there were a lot of wildfires in California. Fourth quarter of 2019 was not immune from these, but on a year-to-year basis, a number of P&C insurers should probably have fairly decent results. And we're looking for the industry to produce an underwriting profit and a combined ratio below 99%. Now, as it relates to the stocks, we think they have several attractive catalysts. One, while the general consensus is for GDP growth of around, let's just say 2.5% to 3 to 5. Many subsectors within the property casualty space are economically defensive, i.e. personal auto. So if the economy does slow, these are fairly defensive names whose demand curve is not overly influenced by economic growth or lack thereof. There are also secular growth trends within the insurance industry as the demand for risk increases as the world becomes a more a hotter and hostile place, and both of those things will drive demand and an increased value proposition for risk transfer. And then finally, while we did see the signing of phase 1 of the trade agreement, property casualty stocks, and to Ken's point about America First, there are global insurers. The majority of insurers are U.S. based. They tend to not be overly impacted by trade and tariffs, and to that degree, they tend to be somewhat of a safe haven. Just to give you a sense of how the industry's business mix plays out, if you turn to the next slide, the pie chart here shows how much personal auto drives industry results, followed by homeowners, which accounts for 55% of the industry's business mix. Those tend to also be the more heavily regulated lines of business because they're personal lines. The other 45% of the industry's business mix is covered by an array of commercial lines coverages. And while this looks small, it's important to remember that the commercial lines market can transfer risk in non-traditional areas like floating catastrophe bonds, self-insuring. So that's why this mix sort of looks like that. And then just a word on underwriting profitability, and this is important when we start looking at the recommendations. I went back to 2000 and looked at industry underwriting profitability, and during this time period, the industry posted an underwriting profit defined as a combined ratio of below 100. And combined ratios are a combination of the loss ratio, the expense ratio, and the dividend ratio. For example, if you're taking in $100 in premiums, but you're paying out $1.05 with all of your underwriting expenses and your claims, your combined ratio is 105, just simply put. It's like a golf score, lower is better. In 8 of the last 20 years, the industry turned a profit. Some of the names we're recommending had an underwriting profit in like 18 of the last 20 years. It's important to consider this as the baseline when we look at the recommendations. So now let's focus on some predictions for 2020. Number one, and to our point about auto accounting for 40% of the industry's business mix, auto is at an inflection point, and we see a number of things influencing the industry and also bifurcating the industry. Shared mobility and autonomous vehicles are going to threaten existing business models. However, we don't necessarily buy into the conventional wisdom that autonomous vehicles are set to put the insurance industry out of business. We actually think that telematics and usage-based insurance are more of a threat and a bifurcating force to the auto insurance industry than shared mobility and autonomous vehicles. And we'll explain some more of that when we get to our recommendations. The second prediction for 2020 is that social inflation is going to rear its ugly and expensive head. And by that we mean social inflation is a rise in claim costs as a result of a change in societal trends like heightened litigation, broader contract interpretations, plaintiff-friendly legal decisions, and large jury awards. There are two schools of thought as it relates to this. There are some who say this is just the cyclical nature of the insurance industry, and right now claims are just sort of in an upward path. The insurance industry will adjust it by raising rates, we'll move on, everything will be fine. The bear case is that we're at a pivot point, and that basically society is changing in terms of its norms, its willingness to accept certain things, and this could be troublesome for the insurance industry. We tend to sort of come down on the middle here. We don't necessarily discount this and view it as just cyclical. We think it's both secular and cyclical. Third, and this should come as no surprise, climate change will threaten underwriting models. This is something that's bubbling up anecdotally. We're going to start seeing empirical evidence. Chaotic and violent weather patterns render historical underwriting models useless and invalid. The takeaway from this is that once these underwriting models appropriately adjust this change and risk, we see a number of lines of business likely to see price increases. And one example is the homeowners line of business. Underwriting models have not effectively captured all of the flooding and the coastal erosion. Once that changes, and we think it ultimately will have to, homeowners insurance is going to be a lot more expensive. And then finally, InsurTech funding will remain robust. And again, this is also where there's conventional wisdom, and then what we see is a little bit of a different situation. Conventional wisdom, or the headline story, says insurance startups are basically going to render the traditional insurance companies obsolete. We disagree. We think that the disruption is more likely to occur in distribution and not necessarily underwriting. We see the moat in underwriting as more sustainable and wider than we do in distribution. We have a positive bias for those insurers who are agnostic as to how their policies are distributed. And then let's turn to some recommendations. First is Chubb, sort of a gold standard, high-end personal lines underwriter that also has an exposure in the commercial lines business so that they can capture some of the favorable pricing trends there. We expect Chubb to produce written premium growth of about 4 to 6% in 2020. Chubb has had an underwriting profitability 18 of the last 20 years, significantly better than industry averages. It is not the cheapest stock in our universe. It's a high-quality underwriter with a diversified book of business, some exposure overseas, which actually tends to grow faster and have wider margins when their economies recover, and has a well-managed, the management team at Chubb is it's a well-managed firm. Our next recommendation sort of strikes at the core of everything that's going on in the insurance industry, and that's Allstate. They are primarily a personal auto underwriter. They are poised to begin another restructuring as they shift from an agent-centric distribution model to one that is more agent agnostic, if you will. We see additional restructuring coming out of Allstate. We think the stock is attractively valued, and we think there's some very interesting things happening here. And we like the shares, and we think they're set to outperform. The other name that is in the PC space is Progressive, which we've highlighted on the next slide. Progressive historically was viewed as a growth story within an industry that really is a value industry. And Progressive has historically grown at double the industry average. We think the Progressive story remains intact. We caution that the investors sort of climb a wall of worry with this stock, but Progressive has a lot of favorable growth catalysts. They have the platforms and the technology to appeal to a younger audience. They are a leader in telematics and usage-based insurance. Most of their business is personal auto. It's short tail in coverage, so the risk profile is known. There's a lot more clarity there. And while we think the stock's growth is not going to be as high as perhaps it was 5 or 10 years ago, we still think Progressive is poised to grow at about double the industry average with underwriting profitability that is top tier. Those are our top picks in the PC space. There are a number of smaller cap special situations, but we think going into this environment, it pays to stay with some of the large cap behemoths in the industry. Next, let's turn our attention to the life insurance industry. We have a neutral fundamental outlook on the life insurance industry. We see both the bull and the bear case. And so the bull case points to a high level of unemployment coupled with an aging population's need to save for retirement as drivers for insurance product demand. We also see that being helped by the recent passage of the SECURE Act, which stands for Setting Every Community Up for Retirement, designed to address the retirement crisis. A big win for the insurance industry here. Annuities are now going to be offered as part of investment options in 401k plans. This is significant for the insurance industry. The bear case, however, highlights the devastating effect the low interest rate environment is having on insurer profit margins and on the quality of loss reserves on their balance sheets. Third and fourth quarter tend to be actuarial review and reserving quarters. And while we think this quarter results on a year-over-year basis should be helped by a number of favorable drivers, not the least of which is a better stock market performance, we do note that there are a number of companies whose interest rate assumptions baked into a lot of their reserving methodologies are still 50 to 75 basis points above where rates are. And at some point, reality is going to come home to roost, and we're going to see more reserve increases. We saw a number in the third quarter. There is a potential there may be more this quarter. The other thing is a lot of life insurers also have exposure to the active asset management business and are now facing the secular pressures that are hurting that industry. Demographics is certainly a topic that is worth mentioning just because it is both a challenge and an opportunity for the life insurance industry as we sort of have a barbelled population mix with baby boomers in drawdown mode and millennials saving and investing. And what we're seeing is millennials save and invest similarly to their previous generations. How they consume those products and how they get those products is different. And this is where disruption sort of strikes at the core of the life insurance industry because this industry is still dependent on an agent-based distribution strategy. So the offset here, though, is that valuations in this group are very attractive, with the average life insurer trading at around 80% of book value. We caution, though, there are value traps, and it's important to really dissect book value and look at tangible book value. Even on that basis, though, the shares are attractively valued. We also think that in a potentially strong equity market performance, a lot of life insurance and multi-line stocks have high betas and could outperform in a rising market. Okay, and if we turn to our next slide. Okay, just to give you a sense of how dependent the life insurance industry is on the annuity business. Annuities account for 30-some% of the industry's revenue mix. It's fairly diversified, but annuities, like auto insurance in the PC space, annuities represent a significant amount of the industry's revenue mix. And then let's turn. Now, this will give you a sense of why I have a neutral fundamental outlook on the industry. This tends to be a relatively slow-growing industry. Profits industry-wide tend to flatline, as the blue line shows us. Again, this is also important when we look at recommendations against this backdrop of flat profit growth. Let's turn to some key predictions for 2020. As we mentioned in our opening statements, disruption in the life insurance distribution model will definitely accelerate in 2020. We see this bifurcating the industry as the traditional agent-based distribution model is really dying. And as we mentioned, demographic and underwriting pressures will probably prompt another round of restructuring in 2020. We're seeing a lot of companies, and a lot of the M&A activity in this space was a function of shifting business mixes, enhancing capabilities, becoming more attuned with what the marketplace wants. So we see the combination of disruption, demographic pressures, and M&A driving results in the insurance industry in 2020. And let's turn to some recommendations. Okay, first is a multi-line insurer, the poster child for the credit crisis, who a decade later remains in turnaround mode. We lost our patience several years ago and downgraded the stock. We now think that there's finally some traction because the combination of a stable to rising interest rate environment, a positively sloped yield curve, and favorable property casualty insurance pricing combined to give AIG dual catalysts to finally outperform and resume the growth trajectory that they had a number of years ago. The shares trade at a discount to book value, and we still think they're in show me mode as far as the street is concerned. But I think once they start putting quarter after quarter of favorable results, again, the noise in their results is significant. It's important to sort of peel back a couple of layers of the onion and look at some underlying metrics like their combined ratio, like their written premium growth. And I think once that trajectory turns positive, the shares should close their valuation discount to their multi-line peers. I'll move quickly because we're going to be running short of time. Lincoln National is an interesting way to play a recovering economy, growing wealth, and increase in demand for annuities. And I'm going to move this along quickly so that I can give Angelo a chance. My last two recommendations are Met and Pru. Met has done a number of restructuring activities to make it less capital intensive. Its business mix is more dependent on premium growth. We think it's an undervalued franchise with a new management team poised to grow and outperform. Our last recommendation is Prudential Financial. Prudential has got an interesting platform, an institutional platform. It's got exposure overseas, and its growth is focused on the U.S. retirement and international markets, two potential areas for growth. Its 5-year revenue CAGR has exceeded the industry, and we think a new management team is also poised to do interesting things here. We are running late. I'm going to turn quickly to Angelo so he can wrap things up.
All right, thanks a lot, Kathy, and hello to everybody on the call. So we are kind of bumping close to the top of the hour. I'm going to do my best to try to get you to 12 o'clock. If we don't make it, it may be, a couple of minutes thereafter. So, thanks ahead for bearing with us. But that being said, we published our top hardware predictions for 2020 last month. I'll go through those predictions, provide our rationale along with kind of the best ways to play those trends. And just to start off, we do have a positive fundamental outlook on the hardware space, which continues to be dominated today by the smartphone market. And I'll tie a lot of our, chipmaker recommendations as well to some of these calls. So first prediction, we anticipate that smartphone units will grow 3% in 2020, reversing a downward trend the past 3 years. This would follow our projection for about a 2 to 3% decline in 2019, which is really what we projected at the start of the year, about a 7% decline from the peak that we saw in 2016. And it shouldn't be a surprise to anybody. We're seeing longer replacement cycles, maturation of the overall smartphone industry in developed countries. That has really kind of been the main reason for the muted shipment growth that we've seen here in recent years. That being said, with replacement cycles now extending to about 4 years, compared to about 2.5 years back in 2015. Our view is 5G should help consumers to kind of get back into the market. We're not as bullish as some others are out there, which are kind of forecasting a super cycle for a company like Apple later this year. We actually think 5G will have kind of more of a longer tail to it, and I'll kind of go through that in the next prediction here in the next slide, which is prediction number 2, we expect at least 200 million smartphone shipments in 2020 to be 5G enabled. That would represent about 14% of all smartphones sold here in 2020. That 200 million compares to just under 50 million 5G devices that were sold in 2019, which was really dominated by Samsung and a couple of China vendors that launched in late 2019. But in 2019, you're looking about 3% of the smartphone market being 5G enabled. We think that number kind of gets to north of 30% by 2022. And just to take a step back, unlike a lot of the new features that have been embedded in smartphones, 5G is not just another handset upgrade cycle. It really is a new technology. So you're looking at new significant improvements in areas like capacity, lower latency, faster data speed, among other things that we really think, again, will kind of get consumers back in the market, probably at a slow rate, but nonetheless, we think it will. You'll see, especially 5G adoption start to accelerate in 2020 for 3 reasons. First, we're going to start seeing lower price points. A lot of the devices that came out in 2019 were at high price points because the component prices were too high. We see those component prices starting to come down here in 2020. Second reason, Apple getting into the market. Apple has historically done a great job, we think, marketing enhancements to next generation phones. And with the help of wireless partners on their end, they're really going to do a great job, we think, in terms of promoting 5G. And 3 is greater availability of 5G on the telecom side of things. Investments today have resulted in only about 5% of the U.S. market having access to 5G. We think you're going to see a lot more. We're going to see a ramp up here in the next couple of years. Prediction number 3 on the next slide here. Biggest risk in our view. We think PC sales are likely to see a sharp decline in the second half of 2020. Again, when you look at the market for PCs, relatively flat from 2016 to 2019, after plunging about 25% from 2011 to 2016. We actually saw growth in 2019 for the first time in about 8 years in the PC market, and that's essentially due to what we saw in the enterprise market. Why was that? 2 reasons. One, we think many in China saw the possibility of tariffs being imposed at the end of the year, so they really increased inventories in anticipation of that risk. The second, it actually occurred effective this week, where Microsoft is no longer going to be supporting Windows 7. So that's really helping demand, and we think the momentum that will continue in the first half, but then start to roll over in the second half of the year. That's going to hurt companies like HP, Dell, and Intel on the semiconductor side of things. So going into prediction number 4, average selling prices for smartphones in 2020 will grow by 5% 5% is what we had last month. We're actually boosted the forecast to 8% this month. Again, that's going to be largely 5G driven. If you look at the cost of a 5G phone, it's going to be anywhere from $75 to $250. There are going to be different types of technology related to 5G, something called high bandwidth as well as low bandwidth. For the devices that are going to have compatibility on the what's called millimeter wave high bandwidth side of things, you're going to kind of bump closer to the $200 plus increase in price phones. The ones that are supporting kind of the lower bandwidth, which doesn't have as many of the 5G benefits to it, we kind of call it more along the lines of 4.5G. You're looking at closer to about $75 increase. I will say this, as far as 5G is concerned, at the high bandwidth side of things, essentially Verizon owns most of that technology. So outside of the US, there's really not much of a need to have that type of access. So going to the next slide here, prediction 5, wearable shipments growth will likely be about 15% in 2020 by our estimates. We think that, wearables remains one of the best areas to be in terms of the hardware market. Clearly Apple is going to lead the way here with the Apple Watch, and they recently lowered the price of their entry watches at $199, as well as the AirPods, which have started to see some significant momentum here in the most recent quarter as they launched the Pro version of the actual AirPods. So we do think ear-worn devices will see some very, very good momentum in 2020. Then you also have the pending acquisition of Alphabet by Fitbit acquisition by Alphabet. And we think that's actually going to help innovation in the overall space and kind of give Apple some additional mojo to kind of work with there. Going to the next slide, prediction 6, we believe Huawei will again gain share in China but lose ground outside of its home market. The two pie charts here really tell the story when you kind of look at Huawei's market share in China from the third quarter of 2018 to the third quarter of 2019, which is the most recent data available. Their market share increased to 40% from 23%. We think that continues here, especially with the ramp of 5G. What we are seeing also, though, and what we think will continue, is Apple has essentially seen the worst of the China side of things, and we do think things will stabilize there for them. Going to the next slide, prediction number 7, we believe that a number of smart home devices will, we think that the number of smart home devices will grow 20% in 2020. Essentially the market here is driven by smart TVs and smart speakers. But that being said, we do think both markets are starting to mature. We actually think the biggest opportunities are going to be within the lighting market, as well as kind of the monitoring and security markets. Shifting to the next slide, 67, and really rounding out our top 10 predictions, prediction number 8, we think HP will make an offer for Xerox. Most of you have kind of seen Xerox has come out. They've made an offer for HP. HP is not taking it seriously. We don't expect them to, especially given the price point there. Ultimately, we think they're going to turn the table here, and they're going to make an offer for Xerox, as we think consolidation still makes sense in the space, and Carl Icahn is a shareholder for both companies, so we think he'll definitely kind of push the needle there. Prediction number 9, we expect another uneventful year for pure play 3D printing suppliers. They've actually come out at the start of the year here on fire. We think a number of new product ramps for both 3D Systems as well as Stratasys will probably help propel these companies higher early in the year. But that being said, the long-term forecasts continue to be scaled down, and we think until that stops, it's unlikely an investable area. And we do actually think the winners in the space are going to be the traditional 2D guys, and as a result, it's a very tough area to be playing unless you think M&A is a possibility, which we don't think at the moment. And then final prediction, number 10, we expect Apple to once again outperform the broader market indices. Apple was up 89% in 2019 versus 29% for the S&P 500. We think the gains here are going to be heavily front-end loaded, at least until we see a 5G launch. And then it becomes a show-me story where things get a little bit tougher for the Apple story and stock. But that said, we love the long-term opportunities there for the company and their free cash flow potential, and we'd stick with the name. Final slide here, 68. These are some of our recommended hardware plays, as well as chipmakers out there that we're recommending. If you're looking for, the more 5G-oriented plays out there, the ones we would highlight specifically is Skyworks Semiconductor or Solutions, which is a strong buy recommendation. Broadcom also a strong buy. And then you've also got Qualcomm. Those are really kind of the connectivity plays that are out there that we would be playing. If you're looking at more of the infrastructure side of things, a company like Marvell would be a great one out there. And then, you can kind of, gauge through the rest of the list here. But a name, an area we didn't highlight, autonomous cars. Many people think it's kind of the next big tech device out there. If you're kind of taking a longer term approach and looking at that industry, NXP Semiconductors, we think, is a great way to play that universe. So I'll leave it at that, and I'll kind of pass it now back over to Sam.
Great. Well, thanks, Angelo. Also, thank you, Ken and Kathy, for your in-depth analyses. Angelo, since we sort of shortchanged you in the end, let me hit you with a couple of questions. What do you see as the biggest risk to the semiconductor hardware industries entering this year?
Yeah, we've obviously seen a massive run, especially in the fourth quarter of last year. So we're kind of starting on a high note here as far as the semiconductor industry is concerned. Our view is the biggest risk is probably also kind of been the biggest tailwind for the stock for these companies, and that is China. If we see any kind of negative geopolitical side of things in terms of China, we think that's going to have a huge negative impact on the broader semiconductor industry, and we do think that there are still risks out there, specifically as it relates to a company like Huawei out there, where we think the U.S. is starting to ease some restrictions out there, but you never know as far as kind of how things kind of take shape over there.
Okay, and what do you think are the best ways to play 5G over the next 6 to 9 months, following the massive run we've had in many of these chip stocks?
Yeah, as far as 5G is concerned, we do think it's gonna be a multi-year process. What we think will happen is kind of the mobile plays will be the best way to play it here in the near term. The infrastructure plays will kind of take longer to play out and kind of have a longer tail. So near term, it's these names have all really run on 5G. We think it is more the connectivity plays. So Skyworks, one of our top picks. Qualcomm, we think, also a great way to play it, as well as Broadcom, although there are rumors that Broadcom is looking to potentially sell their RF business, and we think that Skyworks would be the most likely buyer for a number of reasons, potentially due to the technology that they would want to acquire from Broadcom. But that being said, those are the names we would play in the immediate near term. Longer term, we think a company like Marvell it would be a great way to play 5G on the infrastructure side of things.
Great, thank you. Kathy, we see in the news all the time about the Australian wildfires. What kind of an impact do you see that on your PC industry?
As I said before, a lot of the larger PC insurers tend to be pretty U.S. focused, so I don't necessarily see a direct claim impact on the primary insurance side. There are some reinsurers that are probably going to have some claims, but I think the bigger picture there is the impact of wildfires from a macro perspective, and getting back to the concept that underwriting models are not adequately pricing the risk for these types of calamities.
Okay. Ken, a lot of people invest in bank stocks for the income. What is your 2020 dividend outlook for these large banks?
The large banks are going to become more normalized total return vehicles, competing with REITs and utilities. The consensus looking at this next turn in terms of the federal review looks to be double-digit dividend increases. So yields are going to move higher. There was one other question that came in on Citi I want to get, and the question is, with the golden goose being the emerging markets, what's the risk in those countries? And we think they executed well, but they're really loyal to owning these assets, and shareholder activists could not come in and force Citi to sell off banks in Mexico or Argentina.
Okay. Kathy, remind us again of the Berkshire Hathaway model, and do you see any other insurers adopting this model?
Well, it's interesting. I mean, the Berkshire model is kind of unique, and I would argue that Berkshire stock performance calls into question the validity of that model. But one of the things we're seeing in the PC space, where a lot of companies have excess capital, is adopting sort of a private equity model of investing. We're seeing it at Allegheny, we're seeing it at Markel, and I think other companies are going to be doing that, where they basically take some of their invested assets and allocate it into direct investments, in, vis-a-vis a private equity model.
Okay. Ken, we know that ETFs are just proliferating these days. How can Goldman Sachs be a larger player in ETFs or wealth management?
So they're going to have to do something more than just small acquisitions. We think there's opportunities, perhaps look at State Street with its ETF franchise and an ability to take their large custodial assets, but a strong management. Actually, Kathy covers State Street, but that would be my answer to senior management.
It's interesting. I see some consolidation. I mean, I also follow the asset management space. I see some consolidation there. I have a buy on State Street and I have a buy on Invesco. They both have interesting ETF franchises and could be attractive if somebody's looking to gain exposure to that industry.
Great. Well, thank you everybody for your thoughts. Thanks everybody for tuning in. Good thing we had a lot of information. Sorry we went over a little bit, but we look forward to presenting again after a good first quarter. And let me just remind you again that the session was recorded and that a link to the recording will be made available in the next few days. And if you have not done so and you want to download the slides of today's presentation, you can access them by going to the GoToWebinar panel under Handouts. So with that, I will say thanks again and have a good first quarter.